Welcome to the daily update, where I'll go over the action in the market from Monday, September 22nd, and we'll see how things look for Tuesday, September 23rd. All right, less than a 0.5% gain, but hey, still set a new all-time high with the S&P, the Dow, the NASDAQ 100, the NASDAQ. We're still seeing sentiment not quite exuberant yet, and we're seeing some extreme positive conditions, but we're also continuing to see some negative divergences. So we're a little bit concerned about that because in a good solid market environment, we want to see the whole market going up and we want to see broad-based strength across the S&P 500. We're just not seeing that right now. It's not like we're seeing anything negative, but we're not seeing any real under the surface strength either. But you have to take price for what it is. As I always say, price is the ultimate indicator, and we have to follow that. And price is going up, and we'll have to see if there's any more legs to this, even though we're coming into a seasonal weak time. We've been in a seasonal weak time already, but nothing has happened to this point. Is it going to develop at some point? Okay, so right at the open, we did have a lower open. It looked like, okay, maybe now that it's the Monday after options expiration, which was last Friday, we're going to see some profit taking. And the futures were a little bit negative. Europe was down slightly. And we did have that lower open at the 66.50 level. But then we immediately saw some buying into weakness. Prices climbed back above the daily pivot at 66.56. Then we went positive. We got above the unchanged level. We kind of hung out there for a little bit because on a down day that can act as overhead resistance. No, we broke through it and we got all the way up to R1 at 66.81. And here's an extra bullet point here for you. Then, as the day went on, we continued to climb up to R2. Now we're dealing with the 6,700 level now. Is that going to be overhead resistance? Now, it's not, it was a bit of a technical overhead resistance level that I'll show you here in just a moment because it was a pivot point at the 66.97 level. I'll show you that on the chart, but it's also a psychological level. You know, if the financial media and people could say, oh, the S&P, it's at 6,700. We're just a little bit below that now. Are we going to break above that? Or is this going to be the point where we start to see things stall out? And we close slightly below R2, so slightly below the 66.97 level. We were up 0.44%. That's what I've been saying. We don't see these 1.5, 2% moves up. We're seeing like less than 0.5% move as we've been going up. Not that there's anything wrong with that, but it's not the exuberance that we usually see when the market is truly positive, but it's still positive nonetheless. And the market likes to climb a wall of worry, and these incremental advances that we're seeing, because it was under 0.5% on Friday when we set an all-time high, under 0.5% on Monday. And is there going to come a point when you have the folks that are not really trusting that the market should go up right now? Suddenly they're going to go, oh, 0.5% here, 0.5% there. Hey, I'm missing out on this. I better jump in. That's kind of what we're watching to see if something like that will develop. It's like capitulation to the upside. It's like, well, I'm missing out. And plus, we're coming into the end of the quarter at the end of the month, and you've got professional money managers out there who have their reports and they deal with emotions just like everybody else, and they have people that they're accountable to, and they're like, well, what if I say I didn't ride along with this? Maybe I better jump in too to make things look a little bit better. Okay, we were above average with volume. The Monday after options expiration, now you might have some squaring up because a lot of the options that were exercised on Friday, they had to be or actually dealt with in Monday's session. And so that can bump up volume a bit there. But there were no economic reports that came out. And so it's like, okay, why is the market doing this? And we are positive. You cannot take that away. We are positive in the short, intermediate, and long term. Interest rates were unchanged. We have been coming back up as we tested that 4% level with the 10-year yield. And so we were up just a little bit, but when you round out the decimals, it comes out to being unchanged. The market's really not concerned about inflation right now. Earnings are looking good going forward, but we continue to be overvalued. And I have charts that I show pretty much in every video telling us what we've already known for the last number of years that, yeah, the market's overvalued. Whether you look historically at earnings that have already come out or whether you look forward at earnings that haven't come out yet, we're still overvalued there. But it doesn't seem to matter until it does. Okay, so some comments. The Dow, the S&P, NASDAQ 100, NASDAQ, they all hit all-time highs. Now, this is the same line from Friday because we hit all-time highs on Friday. We had an upward move in Monday's session, so we had all-time highs again in Monday's session as well. Growth did outperform value, and we saw some of the influential stocks really driving things up a bit there. And one of the things, just it's not really impacting the market as much, but it could be having an impact with Oracle here. And that's kind of becoming one of the higher flyers recently. They've always been big. It's a database company, but they're seeming to be a bigger player. Where President Trump will finalize a previously discussed TikTok deal later this week. TikTok's algorithm will be secured, retained, and operated in the U.S. outside of ByteDance's control. That's quite a name, ByteDance, with Oracle to serve as the security provider. So Oracle was up based on that news as well. Personally, I don't use TikTok, and so but I know it's very popular and it's been controversial because it was developed in China and should it actually be allowed to be used in the U.S.? Okay, fine. Then we did get some Fed speak here from St. Louis Fed President Musalem, who said policy is now appropriately balanced between modestly restrictive and being neutral. It's got to be interesting to get into a room with these guys because when you get economists talking about things, like you have one economist talking to another economist and they end up reaching three conclusions. Where Atlanta Fed President Bostic, who's not a voting member, supported just one additional rate cut this year instead of two. Not to be outdone, Fed Governor Stephen Moran, who is a voter, sees the current policy as too restrictive, advocating for a Fed funds rate that is almost 2 percentage points lower than the current policy. So we're running the whole gambit here. You've got the dovish folks, you've got the more hawkish folks, and so it's like, oh my gosh. And then we are still seeing a warning sign from the S&P 500 to the VIX. There's a correlation chart that I'll show you here. It's above a dashed line. We're not getting anything really picked up in the VIX or our other sentiment gauges that we follow, but we're seeing it here. So we want to pay attention to that. And that's a concern that maybe we're getting overextended on a sentiment basis that, again, we're not seeing elsewhere. Now, we are positive, and when you see the Stoch RSI, Williams percent R, CCI charts, and stochastics, those are extreme positive. That's showing positive conviction, and that is still holding up quite well there. But we are still far away from the 20-period moving average, and we're even more extreme than we were after Friday with the short-term RSI. Intermediate term, we're getting even up to the upper end of the +3 channel with the standard deviations chart. We don't go up into +4. At least in the years I've been using this chart, we've never got up that high. But now we're getting pretty overextended in that regard, and that's more intermediate term, but it could also be considered short term as well. We're looking extreme with the Sean trend meter. The money flow index is also extreme positive. We're far away from the upper Bollinger Band now. That's an extreme reading that tends to not last very long. We're also far away from the 50-period moving average, and not only in the short term with the RSI, but in the intermediate term based on 14 periods with the RSI, we're looking extreme there as well. And then we're even further above that, not only 10% level, but 11% level in our distance on a percentage basis from the 200-day simple moving average. And as far as the scenario with the Fed, the only thing I added recently here is that it's looking like there's going to be a rate cut in October and possibly one in December, and even more rate cut, at least one more rate cut going into 2026. And that all this talk up here, that's debating about what the Fed's going to do concerning interest rates down here. And the dollar was down. That did help stocks go up a little bit there, but it's in a downtrend. The weekly chart, the daily chart, the dollar's in a real decline. And we were virtually unchanged with the 10-year yield, 4.14%. We are just ticking up. This is one of the areas that suggests that maybe there's more room to run to the upside because we're not looking extreme as far as sentiment. If we get up into the high 60s, the low 70s, and if we get up to 75, that's when we're starting to get extreme with sentiment. In the meantime, we just tend to go with that, and it is positive. But it just ticked up one notch, even though we're setting all-time highs here, because you have a lot of folks that aren't believing that the market should be going up right now. And so sentiment has stayed lower. It's not really turning exuberant based on this chart. Now, there's some other charts that kind of contradict that a little bit that I'll show. And we are positive with our trend. We're above the moving average. The green line's above the red line. We're above 20, both in the short and intermediate term. And because of the up day, the bias is positive, and the momentum, the last number of days taken together, is also positive there. We didn't have any economic reports, but we're going to be getting some more as the week unfolds, and they're pretty influential, especially on Friday with the core PCE. Okay, so looking here at Goldman Sachs, they have their valuation here and their projections going forward. And now that we've been going up, of course, their projections tend to be more rosy. Then with the PE valuations, this is another one of the, we get this, if not every day, pretty much every other day when I'm doing the daily videos, just showing how we're overvalued. The NASDAQ 100 at 29 times earnings, and we use that 10, 15, 20 scale. We should be down around here at the 20 level. That's when we're expensive, and we're way above that. But we've been there for a long time. Even seeing the Russell 2000, that's looking expensive now. But again, as I like to point out, there's a second index that I follow for the small caps, the S&P 600. That's around 15 or so. So there's a real discrepancy between these two. With the S&P above 20, it's coming in at 23. The equal weight is more fairly priced, but it's been bumping up a little bit too. But the 15 is considered fairly priced. So the 15 to 20 range, that's kind of like the sweet spot from a valuation perspective. And that's been going up. That's looking a little bit better. Where we have the mid caps down here, this is the S&P 400, and they've been lagging behind a little bit, but they're still considered to be fairly priced. All right, and I showed this chart before, but they included it again pretty recently here with the Isabel Net. This is quantitative easing distortion of equity values remain in place and cannot nor will not be unwound. Okay, this is the monetary base here, the light blue line, and that's been going up here, and that's adding liquidity into the system. That's quantitative easing. When the Fed basically creates money out of thin air, they use that money to buy bonds, and that pushes interest rates down. Well, a lot of that market also works its way over to the stock market. And it's like, what do we do with this money? Let's buy some stocks. And so that really helps the market to advance. And then we have nominal GDP, which we'll be getting another reading on that. And that has also been going up lately. And then the corporate equities market value outstanding. Actually, we're a little bit below that, where sometimes this blue line comes in above it a little bit here. Okay, and then I showed a chart similar to this when it relates to the S&P 500. This is the NASDAQ. This is put out by NDR, and this is just taking different cycles together and saying, okay, what kind of a seasonal tendency do we see with this chart? And we're just blowing all the seasonal tendencies out of the water right now because we were tracking along pretty good as we were coming along with the NASDAQ. Well, now the NASDAQ is still going up where typically we would see a downturn right about now. Now, is the NASDAQ going to make up for that? Are we going to totally break away from what historically has happened in the past? We don't know that yet. We're just watching for that. And then financial gold models narrowed the gap during the April to August period when gold traded sideways. And it did. It shot up finally when we bottomed back in April and we started coming up. For months, gold was going sideways. Now it's starting to break out again here. And that's what you see on this chart. Whether you look at the first model or the second model, I mainly look at the blue line here just to track gold itself. Then announced share repurchases. The averages, the dashed line, were well above that, and that is taken as a positive thing. And then gold's up 40% in 2025, its best year since 1979. And of course, all of you really remember that. Uh, and that was, I remember hearing about it on the news, and a lot of people were talking about it at that time. But it's doing quite well. It went sideways there for quite a while, but now it's starting to break out again. And we have to ask the question, why? Why is gold going up? We got the stock market going up. Now, you could say because the dollar's going down, because usually the dollar and gold tend to go in opposite directions. But gold is considered to be a hedge against insanity, against craziness. Now, there's a lot of craziness in the world, but it's not really impacting the stock market. So why is gold going up? I don't have a real answer to that. I'm just saying we should ask that question as to why. Okay, and then spending versus a recession. Basically, the takeaway from this is consumption has never declined in front of a slump. Typically, that means a recession. I think what this analysis shows, and I guess this is Neil Dutta. I'm not sure how you say that, but from RenMac, I use one of their charts over the weekend quite often. It shows that if you are waiting on the consumer to make a call about the turn in the business cycle, you're likely waiting too long because consumer spending shows no slump before a recession, and we're not really seeing that now. Okay, gold ETF flows a lot of money going into gold. It's being chased right now. And then overbought, oversold here. Individual stocks are not overbought, unlike previous tops. That is one thing that's different. We're seeing, again, what we see quite often as we, over the last few years, have been watching this. It's the real big stocks that are really driving the market. And the rest of the stocks in the S&P are like, they're doing all right. So from that particular angle, we're not considered to be overbought, but we also follow the index itself. And then we look internally, and some of the weakness that we see internally is also one of the reasons we're not overbought right now to an extent. Then forwards earnings per share, the forward 12-month earnings estimates for the S&P 500, NASDAQ, and Dow all made new highs on Friday. And this is what drives prices. Because if the companies are earning more, that justifies stock prices going up. And that's what we're seeing here. Okay, so here is the chart. It looked like, okay, maybe we're going to have a bit of a down day. Well, we had a down open, but we got back above the daily pivot, above the unchanged level. And then eventually we worked our way above R1. We got all the way up to R2, and that's about where we topped out, just under the 6,700 level, and then closed just a little bit off of that, but pretty much at the intraday high. And we're not really seeing much of a change in the initial overnight session here, but you can see before the market opened, we actually were looking more negative. And then once the market opened, we turned more positive. So there is some exuberance going on now that's not necessarily getting picked up by our sentiment gauges. And we're still looking okay here, but not great. We're tending to go up overall with the red line and the blue line. We would like the blue line to be outperforming the red line, and it kind of is, but they're pretty much going hand in hand with each other right now. And we are looking okay here. We're above the moving averages when we look at intraday growth in the S&P, and that's improving. And we're breaking out a little bit above this recent range that we were in. And end of day, growth was up a lot more than value, where growth was unchanged for the mid caps and value was down, and growth was up for the small caps. So we saw some improvements here. This has been a concern as the small cap index has been going up. We've actually been going down with the growth to value ratio. This is an improvement, but we haven't quite come back above both moving averages yet. We got back above the 200, but not above the 50. We need to get above this, stay above it, and then eventually see a golden cross for this to be more. Actually, we do have a golden cross, and then see the moving averages start to turn up again here. And also, this is looking better, even though the mid caps are they were down in Monday's session, but we're seeing an improvement here with the mid cap growth to value ratio. Now, what in one way this is telling me, as I look at the next chart too, is that if we do see a decline, that's what it looks like. It might be is a decline, not that we're shifting into some kind of totally, completely different environment. That at some point folks are going to want to come in, start taking profits. That's going to push us down, maybe 3, 4, 5%, maybe all the way up to about 10%. There was a video I watched over the weekend by Chris Shavako from Shavako Capital. He does a video every week, and I'd strongly recommend watching that. And he says we could fall anywhere from 3, 4, 5% all the way to about 14%. and not really damage the bigger picture positive environment that we're in right now. Now, it's going to freak out a lot of people because if we do decline more than 10%, that's where we start to get into correction territory, and a lot of the dynamics can change. But again, we'll just follow it and watch it day by day as it unfolds. And we're trying to get back above the 50-day moving average here with the growth to value ratio for the S&P. We are in a longer term uptrend, but this was causing some concern as we were going up with the S&P and this was going down. If this could continue to improve, of course, that would be more positive as well. And we are breaking out with this growth to value ratio. We're still looking good here with discretionary to staples. That's really been improving. And look at how far staples dropped down. Now, discretionary didn't do all that great either, but staples really went down, and that caused the ratio to go up in Monday's session, setting another new all-time high with large cap growth and declining here, which is positive when we look at the value to tech ratio. And we are positive in the short term. The ADX is above the moving average. We're going up. That's a strengthening trend. It's positive because the green line is above the red line. That same thing here in the intermediate term. Strengthening trend that's positive with the green line above the red line. And we did come down on volume. Last Friday was a spike because it was options expiration, but we were still above average with volume, but we really dropped off from Friday's reading. And then this is a newer chart. This is the gamma exposure by strike. The takeaway here is we're looking at overhead resistance at 6,700. Is that going to be an issue? And we have this blue line coming in here and then a lot of gamma exposure right at 6,700 and they're intersecting each other. So this is just watch that 6,700 level. See if we're going to be able to get above that. And then this is the other sentiment gauge. It's actually looking more positive. We're right on the verge of being extreme here. I don't use this one as much. It's a composite. It takes a lot of sentiment indicators and puts them together, but we only see this chart once a week. I like to keep a closer tab on what's happening with sentiment, but we're coming in at 75.59, so we're just barely getting into the extreme category. Now, this had been negative the last couple of weeks, the legal insider transaction ratio. When this red line's going up, that's more bearish. We're seeing that dropping off now, and that could actually be more bullish. Then this is another sentiment gauge, and there's a theory behind this, put up by Goldman Sachs, things you don't see at the top of a bubble. Now, I'm not saying if we have a decline that necessarily we're at the top of a bubble. We just have had a really good run in the market lately, and at some point, you have normal pullbacks. Even when the bigger picture still remains positive, we still go through periods of decline. And then at some point, that works itself out. Folks come back in and think, okay, I can get back in at even lower prices now, and we bottom out and we start to go up. There are people, of course, the perma bears are going to say we're in a bubble all the time, anytime we have an up day. But what I'm seeing in the research that I do does not necessarily suggest we're in a bubble because we have the earnings behind these companies. Even though we're overvalued, the earnings are growing. There's a lot of capital expenditures that these companies are putting into AI and a lot of these different companies. But it says Goldman's total positioning indicator still underweight in U.S. equities. I don't know. I usually show this in the weekend video, but they changed the day when this chart is actually available. And then I found another version of this chart that has some annotations on here, suggesting that we still have more room to run to the upside. But this isn't a sentiment gauge that I really follow all that much myself. But just be aware of this. And we're still below 20 with the VIX, both with the line chart and the bar chart, which is kind of interesting. We were up and we saw the VIX close up a little bit here. That usually when we have an up day, the VIX goes down. Not a huge thing to freak out about, but still it's typically doesn't work that way. And this is what we've been waiting to see. Are we going to see the VIX really going up as we work our way through September and even into October? And if this is going up, that means stocks are going down. And we're just not seeing that, at least yet. And we're seeing a bit of a pickup here with the VIX of the VIX. This is the volatility of the VIX. We're above the moving average, both with the bar chart and the line chart. So we're seeing it starting to gyrate just a little bit more. This is the chart that I'm talking about. And I showed it for Monday's video. Here it is again for Tuesday's video. This is another way of looking at sentiment where we look at the VIX and then do a correlation with the S&P. we're above the dashed line, and we were above it after Friday. We're still above it after Monday. This means the market's getting kind of nervous here, but we're not picking this up in other charts. But we don't know how high this is still going to go before it tops out and starts to come down. And if you want to see other times when we spiked and started to come down, quite often that led to a decline. Not all the time, but a lot of the times it did. And we're going up with this fear gauge. Again, on an up day, you would expect this one to go down. And we were down just a little bit here with this other fear gauge. So not a confirmation there. And we ticked up a little bit. We saw a real drop off with the daily equity put call ratio chart, and it ticked back up here. But we're declining below this red line. And this is starting to look a little too exuberant. I like the equity put call ratio, but then I don't because we sometimes we see readings in this that aren't really lining up with what's going on in the market itself. But when we get below this red line, that's when we're starting to look extreme. And then other times when we came down to this red line, and we spent a lot of times chopping above and below it back in 2024, and now we're going below it again here in 2025. And you can see other times marked sometimes either a sideways move or something that eventually led to a decline after that. And then the 10-day chart is also going down. Now, this is seen as more positive when this is declining, and it's not necessarily an extreme reading currently. But we're still going up with the risk on to risk off ratio. That's positive. We're still going up with the high beta to low beta ratio. That's positive. And we're not seeing much of a change here with the volatility risk premium. We've hung out above the band, so there's a bit of an increase that's been going on, but we've just kind of stayed at this higher level. And the advanced decline line, again, we saw this after Friday. We set an all-time high with the S&P, but we declined based on price, and we actually were flat to slightly declining here based on volume for the advanced decline line. Bigger picture, we're looking good, but shorter term, we're seeing some divergences. And we're still below the midpoint here with the short-term advanced decline ratio, and we actually declined a little bit with the intermediate term, but we're hanging out right around the zero level. When we're setting all-time highs, we typically will see this way up here, where we're getting really high readings from this indicator. And we're slightly negative with the advanced decline ratio, the short-term one. That's the previous chart that I just showed, the blue line, where we're still positive here based on volume. And that could be under the surface more positive. I pointed this out over the weekend where we're seeing volume outperforming price, and that could be holding things up for right now. And see here, we're going up with the S&P. We should see this at a very high reading right now, and it's actually trailing off as we've been going up. Now, I'm taking that as a negative divergence, but we haven't seen any follow through with price, at least yet. And bit of a drop off with the new highs. Again, setting new all-time highs here, and we're dropping off with the new highs. A bit of an expansion of the new lows. So we're still declining with the 5-day moving average, and we're pretty much flat here with the 10-day moving average of the new highs, new lows. And this looks internally inside of the S&P. Now we look at our smart money indicators, they're all positive right now. In fact, you could make a case that maybe we're getting kind of far away from the moving average here. That's what the boom indicator was supposed to measure, but it doesn't do a very good job of that. How I've kind of shifted and used this is, okay, this is longer term, we're looking positive, and then the boom indicator is more shorter term. What is the direction of the indicator? And we are positive since we're above the moving average and we're slightly above the red line. So yeah, you could make a case that we're getting a little extreme there. And we are going up with the Chaikin money flow. Very choppy last week. But now we've seen two updates here with the histogram, keeping the red line going up. And we're going up and we're starting to get in that initial extreme area with the Chaikin oscillator. Now, this had been going down all last week. It didn't turn positive until after Friday. And now it's really starting to shoot back up. And we want to be careful if we get to this green line and above it. A lot of times you can go back and look. Again, it didn't necessarily mean a reversal. It might mean we slow down, but it could signal that we might be ready for a pullback. But we had an extreme reading not too long ago that just kind of led to a little bit of a downward move before we went back up. And now this is interesting here. We are positive with the vortex, green line going up, but now we're starting to get extreme negative with the red line. That means that there's a real lack of selling right now. And not really showing much of a change here. We're still above the moving average with the advanced decline line studies for the NYSE common stock. just barely above the moving average with the S&P, but we're below the moving average with the mid caps and the small caps. You would expect all of these to go up, especially the top two to really go up on an up day like we saw. And again, another negative divergence here. The stocks in the S&P above their 20-period moving average, setting all-time highs. This is going down and it's below 50 after setting a series of negative divergences here. That's more bigger picture. What I'm focusing on more shorter term is that we're going down as the S&P's been going up. And we also declined with the 50-period moving average study. We went up a little bit with the 100-period moving average study and a little bit of a tick up, but pretty much flat with the 200-period moving average study. So we came up and we're just about at this pivot point. We got a little bit above it, and this could be acting as overhead resistance. We were a little bit below it after Friday. Now we're just barely above it right now. So we'll have to see. What what I do when I look at a lot of different indexes is see, okay, what could be providing overhead resistance? Well, we're kind of there right now with the S&P. I thought it might be the NASDAQ 100, but now we're above that, and I'll show that chart later and talk about that then. But we are looking pretty positive, and the pattern of the bars looking pretty good. For the most part, a series of higher highs and higher lows. And down below, we saw a drop off in volume, but it was still above average. And here we go. We're actually declining with the 20-period moving average study. We're flat with the 50 and flat, trying to go up a little bit with the 200-period moving average study. But then we look at the conviction in the short term. Stoch RSI, Williams percent R, CCI 14, CCI 20, stochastics. Those are all looking extreme positive, and that's showing good positive short-term conviction. And we are coming up, we're just a little bit below the Keltner band here with the force index. So that's actually showing some improvement above the midpoint. Still looking good though with the short-term trend. We're above both the green line and the blue line, and the lines are going up. And here's where we're just at the upper end of the +3 channel with the standard deviations chart. And notice that there was one day here back in July, we actually broke above it. I don't put the +4 channel on here. I just go +1, +2, +3, -1, -2, -3. But we're kind of getting a little high here. But again, we could continue to go up, and this line is dynamic, and it could end up going along with it. Intermediate term, after coming all the way back down to almost the unchanged level, the balance of power is now looking more positive. So that's an improvement there. We are extreme with the CMB composite since we're above this black line. And we are positive with the darker blue bars with the go, no go. We're still at the highest high value. And we're in day 99 now of this uptrend that started way back at the beginning of May for the Landry Light. Also positive with the proper order. We're positive with the TTM squeeze. Now, if this continues to go up and we start hitting this black line, which I put on here, by the way, so there's nothing magical about it. It's just around a level that it seems like sometimes we top out, but we still have a little bit more room to run before we get to that level. But it's positive for the time being. A little bit of a turn up here with the ease of movement. That's positive. And the Arun, we're above zero and going up. That means buyers are outnumbering sellers here. That's positive. But here we go. The S&P McClellan oscillator. It's below zero and actually declined a little bit here when we're setting an all-time high with the S&P. This is showing some of the internal weakness. Also, we've seen the longer-term negative divergences. As we've been going up, we've been seeing lower highs pretty much all along the way here. So we're still declining with the summation index based on price, but we're going up based on volume. The negative side is that we're declining based on price. The positive side is that maybe volume is outperforming price, and this is continuing to look more positive. And we're below zero and declining here with the NYSE McClellan oscillator as well. So and this has been pretty choppy. We're going down just a little bit with the summation index based on price, pretty much flat with a slight decline here based on volume for the summation index for the NYSE. And still not really getting a confirmed signal here. We are going up with the swing and trading oscillator based on price. We're slightly declining, and we were declining after Friday based on volume. We're slowing down, but we're still. Now, this is actually contradicting some of the other things that we're seeing where volume is outperforming price. Here we're seeing volume underperforming price with the swing and trading oscillator. But momentum is positive. We're going up with the PMO. but we're still below the moving average when we break it out based on price. Now we're looking again here where volume is actually outperforming price here because we're above the moving average, but we're not seeing any real strength in here with the studies. These are all the PMOs that for the stocks that make up the S&P 500. We're not really seeing much of an improvement here with the PMOs that are rising. We're below 50. We declined with the buy signals and we're declining a little bit, but still giving a pretty high reading with the PMOs that are above zero. But momentum looking pretty good here. We're above the green line with the slope oscillator. We're positive with the MACD. So short, intermediate, and long-term oscillators are positive, and the Copic curve is positive, but we're still extreme in this dark green area here with the Sean trend meter. Even though we were flat from Friday to Monday, this is still giving us an extreme positive reading. We're extreme positive with the money flow, and we are positive with the ultimate oscillator. We're positive with the on balance volume that's above the advancing moving average, and we're right at 1. That's when the percent B indicator is considered to be extreme. We closed right on the upper Bollinger Band. And again, that tends to not happen very often, and when it does, it tends to not last very long. And what we need to see happening is either the line goes up, the price goes down, or a combination of the two to work off this extreme reading. We are extreme in the short and intermediate term here with the RSI. We're positive with the Elder's Impulse system, positive with the parabolic SAR, positive with our shorter term moving average study, positive with the intermediate term trend study here, above all the plotted moving averages, but we're far away from the 20 and 50 period moving averages. And price has a tendency to bounce back to the moving average, but we've been seeing this now for a few days. And we're getting a little further above the 200-day simple moving average. We're now 11.49% above the 200-day simple moving average. This dashed line is at 10%. And when we start getting above 10%, that's where we get a little bit concerned because you can see other times when we hit some kind of an extreme reading above 10%, then we saw a decline after that. We saw that in 2023. We saw it a couple of times in 2024. We're waiting to see if it's going to happen in 2025. And not really any strength here. The bullish percent index setting highs with the S&P. We should see this very high, up around the 70 level, if not above the 70 level. And it's just not up there right now. Now it's positive since it's above its moving average if you take a magnifying glass out and look at this, but it's not really showing any convicted strength right now and not really doing all that well with the NYSE bullish percent index. We actually declined a little bit here, even though we're still above 50. Now, the NASDAQ 100 bullish percent index, it is looking a little stronger here. It's above 50 and advancing. And this is the longer term support chart. Now it's turning into support. For a long time, we were looking at this as overhead resistance. We spent 3 weeks trying to break above it. Now we spent 2 weeks above it, and we're breaking further above it now. Now, possibly, if we start to see a decline, is this 64, 68 level going to provide some kind of support? Now, we're at 66.93, so we're over a couple hundred points away. So we would already have to see a pretty significant decline just to get back down to this level. And we're breaking out a little bit above this trend line, going back to 2009 here with the S&P. We slowed down there for a while once we hit it, but now we're starting to break above it. Is that going to pose some kind of a problem? Not yet, but we're just keeping an eye on this. But when you look at all the trending mechanisms that we use here, Heiken Ashi is positive, the Kegi chart is positive, the Renko chart is positive, three-line break is positive. Long term, not really seeing an awful lot of strength here with the 150. Now, we are on a percentage basis far away from the 200-day simple moving average. This is a slightly different study, though, here. But you would expect to get higher readings than what we're seeing right now. Now, positive on all time frames across all the different indexes that we follow here, still negative with the dollar across the board, which, as I continually say, that's why stocks have been going up. That's why gold's going up, is because we're seeing dollar weakness. And then we see tech. That's the big area, and that was the leader. That's why the indexes went up. That's why the NASDAQ 100 hit an all-time high and the NASDAQ itself. But then utilities came on, and that's considered to be more of a defensive area. And as I usually like to say, you could also include this in the growth area because of AI mainly. This just huge need that we're going to have for electricity to drive all these AI projects and machines and clouds and things that are out there. And industrials are up a little bit, and you even had real estate bouncing up a little bit here. Staples were down, but they were down more than discretionary. That's why the ratio went up, even though they were both down. But not really solid when you look at the different sectors across the market. And so we had gold, it's going up above 3,700 here. Um, with that. And then we have the Dow, S&P, NASDAQ 100, NASDAQ, Canada, everything setting all-time highs. Party, party, party. All right, so Nvidia was up, Microsoft down just a little bit, and Apple. This is really what drove things. Nvidia and Apple being up. You had Google, both Googles here were down just a little bit. You had Oracle up. You put all this together, and this is why tech outperformed. And the Dow. Now look at this R1 pivot point. I don't consider the Dow to be as important, but it's still important because it's only 30 stocks. But it's what everybody quotes when you say, is the market up or down? Hey, the Dow's up 1,000 points, down 1,000 points. What's the percentage move? That's why I focus on that. But you see how we came up to this R1 point? That was the high that we set on Friday, and we were not able to close above that in Monday's session, even though we did set another new all-time high with the Dow. The diamonds are positive though. That's the ETF that goes with the Dow. And we are above this R2 point here with the NASDAQ setting another new all-time high, closing almost at the high, positive with the Elder's Impulse system. And this is what I was pointing out over the weekend. Turned out to be a non-event, at least for right now. We were just a little bit below this R2 pivot point, and I was wondering if that might provide some overhead resistance. Well, not yet. We actually broke right above that. And we're positive with the Qs looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is positive, and we're above this trend line going back to 2009. That's taken as positive there. And we were up a little bit here with the S&P 600 small caps, and we were up a little bit more with the Russell 2000 small cap index, and we're positive with the Elder's Impulse system for the small caps. Mid caps just kind of humming along. They were actually down a little bit here, but we are still in a longer term uptrend and neutral with the Elder's Impulse system. The Wilshire broad market measure setting an all-time high, as is the total U.S. stock ETF. We're down just a little bit with the financial sector, and it's continuing to underperform. It's been underperforming going back to last spring, but the market doesn't. Is this some kind of a warning sign that we're not picking up on? It hasn't really meant anything to this point. We would like to see the financial sector actually doing better than it is. And the FANG index was actually down just a little bit after setting an all-time high on Friday. So we had Apple up over 4%. Amazon was down over 1.5%. Microsoft still dealing with its 50-day moving average, down just a little bit with Google after it just shot to the moon last week. And Meta was down 1.63%, still above its 50-day moving average. And Nvidia up pretty solid, breaking above its 50-day moving average. And Tesla was up. That helped the discretionary sector. It was up 1.91%. And Netflix just kind of hanging around its 50-day moving average. And we are showing some strength here with the semiconductors. The Dow Jones Semiconductor Index setting a new all-time high, as is the SMH Semiconductor ETF. It's a good day for semiconductors. But we're still going down here with the staples to tech ratio. That's positive. That means the defensive sector staples are underperforming tech, which is growth. And still seeing a fairly strong correlated relationship between US and world stocks. A little bit of a flattening out after strengthening with the longer term correlation. Still heading down into the lower range of the 60s with oil. And we are in a downtrend with the dollar. And we were virtually unchanged, even though, according to this, we were up slightly with the 10-year yield. And this is where we came down and hit 4%. We tested that a couple of times, and we've been bouncing back up since then. If we continue to go up with the 10-year yield, that might cause a problem for stocks if stocks notice that. And we're coming down just a little bit here with the 10-year based on price. But when you look at the Qs to S&P, looking pretty strong here. Discretionary to the S&P, not so much here. Even though discretionary outperformed, it was down when you look at it like on a sector basis. It just was up when you compare it to staples. But we are looking pretty good when we compare large cap growth to value. So we're just a little bit above the moving average with the large caps. Mid caps, that's impressive. And we're breaking above the moving average here with the small cap growth to value ratio. And we're declining here with the staples to S&P ratio, which is positive. Okay, so we're positive on all time frames. Now I'm calling that support longer term, but we're still seeing these negative divergences that are continuing to develop. And we're going to get some economic reports on Tuesday. Now, I don't think these are major, but the other economic calendar that I look at, it counts them as being major. We're going to get the global and services manufacturing and services PMIs for this is the global version. It's the US ones that the market really pays attention to. We'll get the current account balance as well as existing home sales. So not a major day as far as reports, but we are getting some reports. And then all the crazy geopolitical stuff going on. Middle East, Russia, Ukraine, domestic stuff happening in the US, not really having a real impact on the market. And then here is the calendar. It's going to be a fairly light day on Wednesday. Every week we get the mortgage applications. We'll get new home sales as well. Then we're going to start to get some bigger things on Thursday with the initial and continuing claims. We'll get the third reading of GDP. We've seen that number twice now. And they liked it the first time, and then it went up as far as growth and stayed the same as far as inflation in the second reading. What's the third reading going to be? And then durable goods will be coming out. And then the big inflation day is probably going to be Friday when we get core PCE. And this is the other calendar that I use where they think that the manufacturing and services global readings are important. I don't see where they have that much of an impact personally. But hey, that's just the way it goes. Now, when we look at seasonality, we were not only negative for Monday, we're also negative here for Tuesday. Is that going to matter? Where you look at the Dow, S&P, and NASDAQ going back to 2002, not really good stats here. Now, it's not zero, but this is pretty negative overall, and we're also still going through the week after options expiration, which tends to be down more than up. And again, we really haven't been following this seasonal pattern here. There's still potentially some weak seasonality coming in if the market still decides to pay attention to it or not. This also shows how September is usually weak, as does this chart here. And we're in the second half of September, which so far has been performing quite well. And then this is the weak seasonality that we just haven't seen materialize to this point. This also shows how September is weak going back to 1950. So when you look on the negative side, we don't have a really long list, but to me, it's an influential list. The NYSE and S&P McClellan oscillators are negative, and we're setting all-time highs, and that's making, at least based on price, the summation index for the S&P go down. And we're getting a mixed signal here with the Swindle Trading Oscillator. But then you look at the positive side, our three smart money indicators are positive. Maybe getting a little extreme there, but they are positive. Our growth to value and discretionary to staples ratios are positive. Parabolic SAR, momentum oscillators, bullish percent indexes are positive, not showing a lot of conviction now, but they are positive. Ease of movement, money flow, ultimate oscillator, and vortex are positive. We're watching the red line on the vortex because it's starting to get extreme negative. And the momentum for the NASDAQ 100 is positive. The financial sector, again, you look at it by itself, but it's back to really underperforming the S&P 500. And the longer term special K oscillator is positive there. And here are the pivot points for Tuesday's session. I include these on the website, which you're more than free to welcome to check out. Everything's free there right now. Look at the links below the video. And if you are on the website, you get this posted as part of this video. And then there's also a newsletter that I post there where you get access to this at the same time. Okay, so we are positive for right now on all three time frames, and we're above support. In the short term, we are still showing strong positive conviction. Again, we'll be watching different support areas, but probably the most critical one will be the 20 period moving averages if we see a decline. We haven't seen a decline. So we're still well. In fact, we're far away from the 20 period moving averages. And then the intermediate term, we are seeing some things that are looking okay, but we're seeing some weakening as well with these negative divergences continuing to build. And we're positive in the long term, but we're getting almost up to 12%. We're in the high 11% range now when we measure the distance above the 200-day simple moving average. Thank you. I hope you had a wonderful weekend. I hope you have a great day, and I will talk to you in the next video.